Good morning, everyone, both everybody who's here in the room, as well as everyone who's online. For those of you who don't know me, my name is Trish Mosser. I'm a senior research scholar here at the School of International and Public Affairs at Columbia, and I also run the school's initiative on central banking and financial policy. I'm very pleased to be co-hosting today's presentation of the latest Geneva report with the CEPR, who published the paper. Much money, little capital, and few reforms. That's actually an understatement. The 2023 banking turmoil. This is a topic that's very near and dear to my heart, as one of our speakers today, Stein Claessens, knows, since I was part of a group of 30 report about the crisis that proposed a package of reforms, most of pretty US-centric set of reforms earlier this year. So here's our plan for today. Two of the report authors are with us, and they will present some opening remarks. First, they'll probably go about, I'm guessing, 20 minutes each about the details of what's in the report. After that, we will have comments, and then finally we'll leave about 15 minutes at the end for Q&A from you. For those of you who are online, I would appreciate it if you would put any questions that you have the speakers in the chat. That will make things go more smoothly, and I will keep track of those as we go along. My intros of the speakers are going to be really brief because we want to get to the interesting stuff. Starting us off will be Stein Claessens, who's Executive Fellow at the Yale School of Management and the Yale Program for on Financial Stability. But many people know him very well from his previous job, where he was the head of financial stability and the deputy head of monetary and economics department at the BIS. Our second speaker and author is Amit Seru. He's a Stephen, and Roberta Denning Professor of Finance at Stanford Business School. He also is a Senior Associate Dean for Academic Affairs and a Senior Fellow at the Hoover Institution. Last but not least, providing comments on the report and on the presentations is my colleague from Columbia Business School, Suresh Sundaresan. He is the Robert W. Lear Professor of Finance and Economics at Columbia Business School. So without further ado, I'm going to turn it over to Stein, who I think is going to kick everything off here in the room, and followed by Amit. Thank you, and thank you all for coming.
Thanks very much, Trish. Thanks very much for hosting us here, and everybody, thank you for coming or being online. I'm going to give some brief introduction remarks about the report, and then we'll pass on to Amit Seru. We're going to focus a lot on the US, and Amit was the one that wrote most of the part about the US financial system and how it fared in March 2023. He's not the only author. Ignacio Angeloni, Sasha Steffen, and Beatrice Wedemar are also co-authors. Just to introduce the report, why do we think March 2023 is still worth to discuss? That was not a minor event. And if you look at the little chart there, and Amit is going to talk about it a little bit more, the banking failures that then occurred were in terms of absolute values, adjusted for inflation, not out of the realm compared to previous crises. We had an S&L crisis, of course, and it's almost comparable, the failures that we saw in the March last year, and even comparable to the great financial crisis in 2007, 2008. So it's not a minor event, and we should keep that in mind when we talk about reforms as well. We want to prevent things like this. We also focus a lot on Switzerland, and in Switzerland there was even maybe a bigger event, relatively speaking. These people you see there were on Sunday afternoon talking about the failure and the rescue of Credit Suisse. And the money that was put on the table by the Minister of Finance and the central bank who sits on that podium there was equivalent to 20% of GDP, of the Swiss GDP. So if you were to blow it up to the US context, it's about $4 trillion that was put on the table to rescue those. Now, do we still think that, however, given that there are many reports being written, that we can add value? Well, the premise of this report is that, yes, by looking a little bit at longer run trends that were underlying those vulnerabilities that came out in March 2023 and discovering that some of these things are still there, both in terms of monetary and financial policies, but also in terms of reforms that have not been addressed. And that's why we end up with the title, Much Money, Little Capital, Few Reforms. When we think of that holistically, we still have that puzzle that we need to solve going forward. Now, the report is quite a bit of things to cover. We try to be, in some sense, not covering everything, and there are going to be pieces we're missing out for. But we went through both what caused it, what were the events, and then what were the underlying problems, both in the US, but also in Europe. We're not going to talk about it here now today. And then what are the solutions in terms of both on the regulatory side, but also on monetary policy side. And we're going to come up with quite a bit of recommendations. So we're not going to do all of that in the time we have today. I'm going to present the things that are in red. Amit in blue. There's no color coding here, so don't misunderstand us here. And we will talk briefly. I will talk briefly on the events, just to remind you what was happening. I will be very short there. Then Amit is going to talk more detail about what happened in the US. Like I said, we're going to skip the European part, so that's the black part that we're going to leave out. Amit will come back to some of those issues in terms of reforms as well. So he's going to pick up a little bit what's in 4 and 5. And I'm going to end up with talking about the failure to integrate monetary and financial stability in a more general sense and how it mattered this time. Now, just as chapter 2 is really the reminder, so all of you were there in some sense, I'm sure, observing this and having studied some of the papers. But just as a reminder, what happened in the US, I think that one thing that stood out was the speed of outflows, right? That was very, very rapid if you look at it in historical context, and really necessitated very quick responses because the contagion that was about to occur, or was actually occurring, was very, very high. So there was no choice but in that weekend to invoke the systemic exception for that very reason. So that was the US. Similar things happened in Switzerland because the debt of Credit Suisse, which was in some sense long in the making, unfortunately, and hard to correct itself, it started to accelerate. And if you look at the trend, the yellow is the prices of the general banks in Europe, and the red, and it's also the price to book ratio, started to tank for Credit Suisse specifically in 2020. And in that 2-year period, it went down to the zero level or near zero that we ended up in that March weekend. So it's another example of you can have a sudden death even though the things are happening earlier before that. And in both cases, like I said, there was a large need for large interventions. Now, those interventions were the systemic exception, were the term funding, etc. They were significant, both in terms of the volume, but also in terms of turning around the thinking and the market reaction. So what you have here is the prices that are benchmarked on that weekend, March 15, a little bit earlier. And then you take the bottom two, which are the prices for the stocks of banks in Europe, which is the second line from the bottom, and the lowest one is the US. And actually, the US fell the most in that moment, in that month, but then it recovered, and it recovered slightly slower than the European ones, and the European ones recovered relatively quickly, so that by the end of a year later, they were more or less back to where they were. You can also look at the stock market. The stock market on the top is the US S&P 500, and then you have the European equivalent to that. They recovered as well. And in some sense, you can argue, well, we didn't see much of a long-term impact, both on the banks nor on the stock market. So maybe we did okay, and the long-run economic costs were not that high. I would say no, that's really thinking too short-term. These are still imperfect markets. The S&P is driven by a lot of other stuff, obviously. So don't take that away. And also I'm saying that because the reforms that were on the line already happening in the background, of course, were incomplete going into the crisis. Clearly they were incomplete because otherwise we wouldn't have had the crisis. Of course, it was also about supervision. We're not going to talk as much about that today. But there was also still a continued delay after the crisis. So we still are in this situation in which major countries, and I'm talking here Europe, including EU, UK, and Switzerland, as well as the US, where the reforms are lagging. And one way to do that in a very succinct summary way is to look at the chart here that the Basel Committee puts together on a regular basis for the banking reforms. This is as of September 2023. Now that is, you could argue, after the reforms, well, after the crisis, but actually a few reforms happened within those few months. So it really is this situation at the time of the crisis. If you take the situation on the very right, the yellow, you can't see all the names, but it's basically Switzerland, Europe, US, and because it goes alphabetic, and the UK. And those countries really are all in yellow at that time. So 2023, more or less around the time of the crisis. Now the reforms, meaning in other words, it's a color scheme of a traffic light. We're only halfway there. Basically, the regulation had been published in draft form, but not adopted. Now you fast forward to this September, you would think, well, you must really have done now better. You knew there was a problem. Well, yes, the Europeans, the first three columns have done, but the one that's in yellow there and that I'm highlighting here is still the US. The US still is only at the draft publication term and maybe even delaying further, which the maybe is actually not a question mark. It's probably given that we're going to see from further delays in terms of the Basel III endgame. So we're still in some sense not tackling the fundamental issues. So this as an introduction. I'm now going to pass it to Amit, who's going to give you the diagnostic of the issues in the US, as well as some of the resolution. And then I'm going to come back to the role of monetary policy. So let me exit here from the screen. And you can pass it to me.
I'm trying to pin him. There it is.
Can I start?
Yes, please go right ahead.
All right. So thanks to Columbia University and CEPR for hosting us. So like Stein said, I'm going to be talking about US. A lot of discussion started around the Silicon Valley Bank's failure. We had seen a bunch of failures before around the Great Recession, but not really since. And the question was, why did this happen? What can we learn from this, really? And was SVB just an outlier? And what the report discusses is we can do a quote-unquote stress test of the banking system, exactly the kind of events that happen in Silicon Valley banks. If we were to do that kind of analysis for the entire banking system, what would one get? Because that would give you a sense of how wide the problem is and what we can learn from it. So that's what we sort of discuss in the report. And to understand that, here is the US banking system as of Q1 2022, before the interest rate tightening began. So $24 trillion of assets spread across securities, a lot of them liquid securities, loans, cash, and others. A balance sheet which looks like Silicon Valley Bank, but expanded to the whole system. So $24 trillion there. On the liability side, $9 trillion of insured deposits, $9 trillion of uninsured deposits. So that's a pretty big number, not just Silicon Valley Bank, but many other banks had uninsured deposits. Now we know that. And $2 trillion of equity. This is something that I'll get back to very shortly. So this was the US banking system. And then when the interest rates rose, the value of the long duration assets fell. So what we did, and when I say we, me and my collaborators, which will appear at the bottom of the slide, as you see, looked at the maturity and the repricing structure of loans as well as securities and did a mark-to-market exercise. And when the interest rates rose, the value of these assets fell. We kind of understand that. And what was the magnitude of these losses? Well, we computed that it would amount to about $2 trillion of losses on a mark-to-market value basis. And just as a reminder, remember, we have about $2 trillion of equity in the banking system. So that tells you, well, there is a lot of losses. And if push came to shove, as in you had to actually liquidate these assets, we would not have enough capital in the banking system. So we call this turbulence because it was a large enough shock. And just to give you a snapshot of what it looked like, So $2 trillion of losses spread across assets, but a lot of it in liquid securities. So that's what is different here relative to, let's say, a Great Recession. So $1 trillion or so in RMBS and another 300 billion in treasury securities and so on. And if you remember, these are numbers which are very much higher than what the Fed and FDIC was estimating early on, and partly because they didn't do the stress test for the entire asset side like we did. What it also told us was, well, this is something which might affect a broader set of banks than just SVB, because this is of the size of the US banking equity, like I just mentioned. In fact, if you look at the distribution, what you find is there are 500 banks which have losses more than SVB. So there's a lot that you can learn from the distribution of losses, and that's why we called it turbulence. Because if you looked at the distribution, yes, SVB had large losses, but there were a chunk of other banks who had losses more than SVB. So if losses were the only factor driving the runs that we saw on SVB and then later on First Republic and others, we would have said, well, yeah, there should be 500 banks that are failing. Maybe the answer was banks were hedging a lot. So we looked into hedging. The light orange distribution here is the duration of assets, which is a quick way of knowing how much exposure you have to interest rate risk. And what you find is the light before the tightening and dark after the tightening, your duration is more than 0, which tells you that you are exposed to interest rate risk, you as in the banks. So hedging would not take care of any of the losses that we talked about, and I'll get back to it again when I talk about bank management practices. But maybe then why did SVB fail and not others? Maybe it had something to do with equity. But if you know anything about the US banks, you know that most of them are very highly levered. Again, a point that I'll come back to. And if you looked at the distribution of equity, what you find is that there are 400 banks or 500 banks with very similar debt to equity profile like SVB. So equity doesn't set SVB apart. So that's not something that we really learn a lot from, except that SVB had losses and 500 banks had losses. So what then explains this? Well, we were looking into this concept of uninsured leverage for some time, and that has a huge role to play here. So what do I mean by uninsured leverage? Well, think about a simple balance sheet there, and uninsured leverage is how much uninsured deposits you have. They are important, as we now know, because there are 9 trillion of them in the system, but also that they are very spooky. So if there are losses, they are very runnable. So you need to keep track of the liability side, and in particular, if it has uninsured deposits, which we consider and call flight risk. So if you look at the distribution again, was SVB something of an outlier here? And it turns out it was. So if you plot the distribution of uninsured deposits in the system, the vertical line is where SVB is, and now you see very few banks had the same level of uninsured leverage. That's not to say that SVB was the only one. You can see there are many, many banks which have 40, 50, 60% of their liability structure as uninsured leverage. So then the insight that we had was to put together flight risk with turbulence to see if we can understand better where one might see runs and where one might not see runs, because there is the notion that deposits have a franchise value, which actually helps alleviate runs. And what me and my collaborators sort of got at was that when the interest rate is high, and as a result, with long duration assets, you're going to have a lot of mark-to-market losses. If you don't have enough equity, which means you can't buffer those losses, and if you have a lot of uninsured depositors who are awake and spooky, you can sort of end up in a system where there are no runs because the deposit franchise might be enough. But you can also end up with a solvency run equilibrium where bad run emerges because uninsured deposits run, banks have to liquidate their uninsured, their mark-to-market losses laden assets, and that triggers more uninsured deposits to line up and leads to a run, which we saw in SVB. So then the question was back to the stress test of the whole system once we have this notion in place, and we lined up turbulence, which is mark-to-market losses, high to low, and on the y-axis, and flight risk, which is how much uninsured spooky depositors do you have in your capital structure on the x-axis. And we said, let's line up all the banks to see how much potential solvency runs are we facing in the system. So each dot that I'm going to show you here is a bank and a potentially insolvent bank. And what is a potentially insolvent bank? Well, it's one where mark-to-market value of the assets after paying a proportion of uninsured deposits is going to be insufficient to repay all insured deposits. So, if your uninsured deposits of a certain proportion are going to run and you have mark-to-market value of your assets, which is depressed, you're not going to have enough to pay your insured deposits. And, FDIC comes in and shuts down the bank and so on. So we kind of decided to plot this. Each dot here is a potentially insolvent bank. There are a lot of these. Now, just to give you a calibration, there are about 5,000 banks in the US system. And we are talking about 1,000-ish dots here. So there is quite a few potentially insolvent banks. Yes, there is SVB there, high flight risk, high mark-to-market losses, but there is a bunch of others in this, which we call as potentially risky banks in terms of facing insolvent risk. So one can do this stress test in a bunch of ways. You can move around the proportion of uninsured depositors that you think are going to run. And if you do that, the more they run, the more the number of banks fail. How many run? Well, we don't know that. So that's why you do the stress test. And we sort of talk about this in the report. And our preferred numbers are, well, let's assume that 50% of uninsured deposits, our depositors are going to run. How many insolvent banks are we going to see? And we find that, about 200 banks, like I showed you in the picture before, around SVB in that dotted spot, are going to be ones which are going to be potentially insolvent. And you can also look at what's the asset side of these banks, and you find that you're going to get about $300 billion worth of banks who are potentially insolvent, though there could be many more. And one of the things that I sort of want to mention here is the size of the dots here is the assets of the bank. So a small dot is a small bank, but there are enough number of biggish banks. So SVB was a $200 billion bank. You also see a very big dot there. That's a potentially GSIP in there. So lots of banks, lots of potential insolvency, and one can sort of look at that. Now, when I did this analysis with my collaborators, we've only looked at interest rate risk. You could also ask, suppose you added credit risk, what would happen? Because credit risk is kind of important. That was the reason for thinking about a bunch of reforms during the Great Recession, for example. And commercial real estate loans are the ones where one has a lot of discussion. So suppose we go through the exercise of refinancing being hard in the commercial real estate because people work from home now, so the value of office buildings is lower. If we go through the idea that house prices have fallen, and as a result, value of properties have fallen, so refinancing is hard, and then simulated out the defaults that one might see in the commercial real estate, and ask what's the number of additional potentially insolvent banks, so additional to the dots that I just showed you, you will find that we are talking about another additional 50 to 100 banks on top of what you saw before. So not a big number, but it can matter because it's a lot of mid-sized regional banks that we are adding to this previous level of insolvency that I sort of showed you before. So at this stage, you might ask, like, okay, so what about regulation and regulators? Well, the problem is that if we are always fighting the last war, and you're a hammer, everything looks like a nail. So regulators diagnose this as a liquidity problem. Like you can see this from the Fed report on SVB. Liquidity was mentioned 320 times, solvency once. That should tell you a little bit about how they were thinking about it. But this is a problem where this was not, first of all, a liquidity issue because there were lots of liquid assets. Their value is depressed, but they are not traditionally thought of as illiquid assets. So not a surprise when a lot of liquidity interventions happen, banks have kept failing. SVB, a lot of liquidity intervention, First Republic failed, and a bunch of others. And one has to wonder why that's the case that we diagnosed it the way we did. Now, of course, there's bad management, and I know that our discussant is going to talk a bunch about it. But I thought that we should mention a few things where bad management sort of shows up in the data. And in particular, if you go back to hedging, there is one practice that accounting allows us to do, which is classify securities as hold to maturity if they are illiquid securities, not liquid securities. So if you look at the distribution of securities that are classified as hold to maturity versus AFS for sale in maroon, what you see is that over time, more and more securities were put in and classified as hold to maturity. And in fact, if you looked at how much reclassification happened in dollars, we are talking about $1 trillion of securities. Remember, liquid securities moved from sale to hold to maturity, and reclassification, of course, accelerated, as you can see, as interest rates rose. And this is a pretty bad practice, management practice, I would say. And if you ask, like, how much additional losses were hidden on the balance sheet, still are, we can see that we are talking about $175 billion of assets. You can see that in the blue line, and it kind of increased when the interest rates rose. And it's a pretty big number because if you compare it with the CET1 equity, we are talking about 15% of that getting wiped out just by this, if we were to actually do the things properly and didn't lean on bad management. Now, that's one aspect that the report touches a little bit, but the other aspect that the report talks about is that, like, we sort of underestimate something more fundamental that might have been also going on, which has repercussions on the kind of policies we want to go after, which is the political economy behind regulation and enforcement. And in particular, I want to talk about the scenario in the US where the regulation of and supervision of banks is done on a rotational basis between multiple regulators. And when you have fragmentation of responsibilities, different incentives of different regulators can actually lead to more forbearance in the system than we might otherwise like. So here is going to be an example that I'm going to show you where a bunch of banks, a huge number of regional and middle sized banks, in fact, are regulated by state and federal regulators in rotation. What ends up happening is they get a CAMELS rating. For those of you who know CAMELS, it's basically the pillar for supervision. It goes from a number 1 to 5, 5 being bad, 1 being good, as in 5 is tougher than 1. And when the state and federal regulators supervise banks on a rotational basis, the advantage is you can look at the same bank virtually at the same time, getting rating from a state regulator versus a federal regulator. And what do you find when you looked at this data? Well, what you find is that the federal and state regulators give very different ratings to banks. When the states come in, which are going to be all the white bars here, followed by a federal spell, which is gray bars here. So what happens to the CAMELS rating on the y-axis? Well, when the states come in, they lower the CAMELS rating. And when they are followed by the Fed, they raise the CAMELS rating. And when the states come in, they drop the CAMELS rating, as in the states are more laxer. And one finds that that's increasingly the case when the banks and the local economy is not doing well. So just as a reminder, when you go back to this picture that I showed you before of potentially insolvent banks and ask, like, hey, how many of these banks are actually on the rotational basis? All the red dots here are on the rotational basis. So this is another way of sort of saying this, is that there's a lot of forbearance in the system for exactly the banks that you might be worried about, because they have a lot of potential insolvency that they'll be treated in a lax manner. And that is a problem. Why is that a problem? Well, if you are old enough to remember, you might remember that when you have a bunch of potentially insolvent banks and a lot of guarantee from the government, you worry about gambling for resurrection. And that's what we have in the current system too, a lot of losses and a lot of backstop from the government. Yes, we have stopped the runs in the medium term, but we haven't solved the problem because the insolvency remains. And the SNL crisis kind of tells us that when you have turbulence and losses, the losses that you worry about, of course, are related to interest rate risk, like in the lower part of these losses that one knows emerge from the SNL crisis. But what you really worry about are these losses in yellow, which is gambling for a resurrection that happened during the SNL crisis, and that's the same problem that remains. So what can one do in the long and short run? We talk a little bit about this in chapter 4 and 5, which Stein will come back to, but let me just preempt this a little bit. Well, remember, we have the problem that we have a bunch of uninsured deposits, mark-to-market losses, which are huge, and not enough buffer in the system because our equity is not as much. So the first thing is to try and separate out how many illiquid but solvent banks do we really have versus completely insolvent banks, because if we pool all of them together, that doesn't solve the problem. There's a lot of forbearance then in the system for not really anything. So what we sort of talk about is a proposal that I had written with my colleagues at GSB and the other collaborators who you have seen before, including Tomek Piskorski at Columbia. And what we talked about is doing a market test to help us separate out which are the insolvent banks from solvent but illiquid banks. And we think that raising equity capital or market-based financing will help us with some of this. And we do some of the computations, which I will not spend too much time on. But the point is that the losses can be sort of taken care of if we went this route. And you're talking about private capital of about $200 to $400 billion to solve this, rather than waiting and for gambling for resurrection to take place, which might end up being way more losses than we are hoping for. And there is enough capital in the system. And then let me just conclude with the longer run situation here. Well, remember, we can lean on regulators, but regulators have their own political economy. There's forbearance tendencies, so we can't just lean on regulation, especially with fragmented regulators, to solve everything. The fundamental issue in this whole discussion is really that all of these crises emerge because banks have very high leverage. So this is banks in the system, and you can see that pretty much regardless of the size on the x-axis, and if you look at the leverage debt to assets, it's pretty high. And so what is the longer solution? Well, we talk about capital, so that's why we say little capital. And there are lots and lots of benchmarks to see that banks can provide the same amount of services, banking services, with higher amount of equity potentially than what they are doing. And a simple example, and there are many such examples, come from the non-bank or private credit, as it's called right now, side of the economy, where there's a lot of intermediation happening. They are non-depository financial institutions, so they don't face the same amount of regulation, but they are able to provide a lot of services, and the market asks them to hold a very different kind of debt in their capital structure. In fact, the market asks them to hold much more equity because they have entire liability structure, which is uninsured. Remember, banks have insured and uninsured deposits. A non-bank has everything which is uninsured. And the prime example comes from this picture, where if you look at the US mortgage market, for example, the dark red line is banks, and you can see pretty high leverage. And then you can see the gray line, that's non-banks. And they are also providing the same services, which is mortgage loans. But if you look at the amount of debt they have in the capital structure, it is much lower, which means they have more equity, entirely driven by the market. And in fact, if you look at the regional banks, which are going to be in that part of the dotted circle, you see that their leverage is substantially lower, and that's what the market is asking. So when we say that you can do banking services which potentially more equity, that's looking at examples which are providing the same kind of services. So in the longer run, to absorb interest rate risk related losses like we have seen in this crisis, or other losses like credit risk like we saw in the Great Recession, ultimately having more capital is the way to go, and we don't think that the banks are necessarily there yet. So with that, let me stop because I covered quite a bit, but I'll let Stein conclude how all of this fits together with everything else. Thanks.
So let me continue. And after Amit's talk about US banking, he really took a macro perspective in the sense of the balance sheet of individual banks. I'm going to take it back a little bit more to the, in some sense, the title, Much Money of the report, and talk about the role of monetary policy, which is in the background, I think, a more important driver than we may have thought. And it's always exposed, of course, but nevertheless, there are some signs that were plainly in sight if you would look at the basic data. So, what do I mean by basic data? Well, look at very basic things that we used to study, maybe when we went to grad school a long time ago, but even after that, monetary aggregates, M1, M3, M2, the basic foundation in some sense of our textbooks. And then we saw an enormous spike during the COVID period, both in the US and M1 and M2, because we had a large interventions in terms of asset purchases. Some people call the QE infinity, right? In March 2020, the Fed started buying up 75 billion a week in terms of treasuries. And that led to this 70% or so increase in M1, which was huge because liquidity was being pumped in the system to save the economy at large and the financial system. All fine, and we had the benefits of it, but it came with a cost. And just to put it in perspective, and again, this is the same color coding, but now the US is blue and Europe is red. The increase in the US was much higher than it was in Europe. In Europe, partly because there was a bank-based system, they didn't need to use QE, they could do liquidity through the banking system, and that meant that there was less growth in M1 or M3 for that matter. The US doesn't report M3 anymore, but M1 and M2 in the US was a magnitude larger during that period. This is basic statistics, but it brings you back to the agate question. What does the liquidity do to the banking system at large? It has to be absorbed. It comes because the Fed buys assets from the non-banks, then the non-banks get a deposit into a bank because the Fed has to pay the bank for the treasuries or whatever they buy from the non-banks. And that's the cause of the liquidity in the banking system that suddenly spikes. In addition to that, we had, of course, the interest rate movements. Now, interesting between the US and the US as a comparison, US had some increase in interest rates in 15-17 and then went back down. And then, of course, we had a recent increase, but I really talk about before 2022, the comparison. In Europe, interest rates, and these are the blue lines of the policy sense, were on a declining path throughout, even to the point that people said, well, there's no zero lower bound anymore. There's an effective lower bound, which is negative in the European sense, and nobody knew where it would end up. Maybe it was even going to be -1. It didn't go all the way down there, but nevertheless, there was only a one-way thinking in the European sense. Interest rates are going to go down forever, whereas in the US, there was a little bit more up potential. Why I'm saying this? Well, it meant that money demand became almost undefined in a US sense. And you can think of it from a personal perspective too. You left your money in the bank because there was no really alternative in the first place. So interest rates were low. They only could go up, so leaving it there was fine. Whereas in the European sense, leaving it there was not fine in the first place because you were getting penalized, and there was only going to be an upside and a downside in the European context. So the comparison is useful also on the interest rate side, that things were slightly different. Now, what did this do for the US financial system? Well, besides what I mentioned, that QE increased the central bank's reserves and bank deposits and liquidity more generally, you got this risk management problem at banks that they became quote unquote lazy. The technical term is liquidity dependence, but I call it laziness, that they didn't need to manage their risks anymore on the liquidity side because there was a lot, you can always get money from the central bank, or you already had reserves there. It meant on the depositor side, as I mentioned, I don't want to think about my money because whether it's short or long term, it's the same thing. So I'm going to keep it short term, who cares? So short maturity deposits increased. All that, as I said, stronger in the US. It also meant that the banks, on aggregate at least, couldn't control the deposit inflows. The Fed was dictating that by the purchases of the QE. The individual banks had only limited tools because the maturity structure that you might sometimes use to influence your term deposits didn't really work because people didn't care about term deposits because they were paying the same as short-term deposits. So for many banks, the only thing left was to think, where do I park the funds? And this brings us back to the problem that Amit laid out. Where do you invest your money? And then if you're a certain bank, you invest it wisely. If you're not so good as a bank, you may invest it differently. And that showed up for the system as a whole, just as much as it showed up for the individual banks. And just to give you that picture very briefly here, so we're going from the right, the deposits increased because of QE. That also meant that assets went up, of course, the balance sheet is balanced. A little bit of equity is a difference there. And that largely went into securities, of which most were treasuries, if you include agencies ones, so it's 1.9, 1.6 is more or less there. There was a little bit of cash as well, and cash includes reserves, so we're talking about the same thing here. And at the same time, lending marginal. Now, if you take that, this is 2019 to 2021, just before we got into March 22 to the QE period, including so this was all COVID related increases. Now then you ask the question, what happened when interest rate rose? Well, then we see the adjustment that on the aggregate wasn't very large. So the numbers here are talking 200-300 billion in the various categories. But for the individual banks, as we saw from Amit's, were a major change. So these numbers here, particularly if you go back in terms of percentage increases in the earlier period, let's call it the COVID period, were humongous. So the increases in securities was a 50% increase. The increase in treasuries was 53%, and the other categories are very large as well. Now that translated to the banking system as a whole, and then you had those individual banks. So then I go back to the three failed banks that Amit included, SVB notably, but also Signature and First Republic. We know them, we know their business model, we know more or less their size, 200 billion for SVB, 75 for Signature, and First Republic another 230. But they really had grown tremendously because of this influx of liquidity by 350, 250%. They had increased their uninsured deposits to percentages that were in the 88 for SVB, but also in the upper 60s, 70s for the other two. And they had a large security portfolio, at least for SVB, and to some extent as well for the other two. So these banks were taking a big interest rate risk that was driven in part by the aggregate push of liquidity that they could in some sense not resist, or at least not manage very well. What does it mean? Policy recommendations are obvious. Well, in some sense, low for long and large asset purchases mean risk for financial stability. These monetary aggregates that are very basic, that we tend to ignore, are very informative there. The monetary policy should then coordinate better. And when I say coordinate, it doesn't mean that monetary policy should wait for financial stability and in some sense sit in a room and do things together. We do want some separation between these two. We want them to talk more specifically to each other. This is where our recommendations then follow. Have more analysis between what monetary policy does for financial stability and vice versa, what financial stability is needed in order to get proper monetary policy transmission. The staffing, often you have this Chinese walls or no exchange. We don't necessarily want that between financial stability and monetary policy. You want the risk to be assessed more systematically, both of conventional and unconventional monetary policy. We want to look at the interest rate scenarios, and this was a major failure in the US stress test that only included declines because the philosophy was if there ever were to be a recession, we're going to lower interest rates, so we don't need to raise interest rate and do a recession at the same time. This stagflation kind of scenario was never included. We need to include those things. And we have to maybe at times think how monetary policy over a longer path adjust to take into account financial stability concerns. It's during a period of low for long that the risk of a crisis are pretty soon. So that is one of the recommendations. There are many more in the report. Like I said, we're going to keep it short. 4 and 5 are about institution recommendations. Amit talked about them, but we also have a European part of it. So I'm going to leave it here for the discussion to pick up, and then looking forward to the questions after that.
Thank you very much for having me in the program. It's a pleasure to be here. I just want to commend this book to you if you have not had a chance to read it. I found it quite thought-provoking, and what I like about it is the way in which they ground their recommendations by actually giving us a historical perspective and relying a great deal on extant academic and policy research, G30 reports, and empirical work. So it's very well grounded and gives a very nice perspective. So I highly recommend it. The book covers a lot of ground, and in the limited time that I have, what I've chosen to do is to focus on a couple of key recommendations and raise some questions for Amit and Stein. Uh, uh, I broadly agree with the idea that more equity capital is needed. And as Amit pointed out, it's somewhere in the neighborhood of 190 billion to $400 billion based on some of the stress tests that explicitly takes into account some of the monetary policy issues that Stein brought about. Couple of questions. One, we know that we've been down this path before, and the lobbying power of banks is pretty high. And so how practicable is it for us to actually think that this level of capital could in fact be infused into the banking system in a short period of time? And second, if we were to increase the level of equity that banks have to hold, then we must take into account the fact that the return on assets for banks is somewhere in the neighborhood of about 90 basis points to 140 basis points over the last 6 years. So certainly some banks are going to leave the system, and the banking is probably going to get a little bit concentrated. There could be other non-bank players who are differentially regulated and perhaps less regulated, like private credit, for example, that Amit was talking about, could enter, and we don't know what the final outcome is likely to be. So there are some questions about what would be the effect of increasing equity on aggregate provision of credit, allocation of that credit, because the private credit may be not going into the same area as a traditional banking credit, and what is the cost of credit. Now, Amit gave a very good example. I think it's figure 5.1 from their book, where how non-bank institutions come with higher equity capital, especially in the mortgage business. I want to kind of ask the authors whether their entry was facilitated by the presence of too big to fail GSEs, which were essentially guaranteeing these mortgages so that these non-bank institutions could come in. They don't have to hold their mortgage portfolio on their books. They could basically wrap it around Ginnie Mae, Fannie Mae, and Freddie Mac, and then distribute it to other ultimate investors. So their business model is very different. And since they're not holding over too much of these mortgage portfolios on their book, perhaps they could carry more equity. This is just a question that I would like to pose to the authors. Now, another recommendation that the report makes is provide fiscal backstop and a wall of liquidity. The wall of liquidity is a little bit reminiscent of the report that was put out earlier by the 30 reports, a G30 report, where essentially the idea would be that you pre-position a lot of collateral to the discount window to be able to cover all your fragile liabilities, including perhaps non-insured deposit. My question here would be for us to think about is the fiscal backstop is something that we're going to price ex ante, and this will be paid by banks in good states, and is the pricing state contingent, reflecting the state of the economy. In other words, who are going to bear these costs associated with this backstop? And it clearly has some implications for FDIC premium and deposit insurance fund that we need to think about. Now, let me move a little bit to an overview of the discussion. I really want to look at two big issues here. minimizing unintended consequences of banking reform and incentivizing early intervention by senior managers. So let me talk a little bit about banking reform, which ought to take into account other key players in the banking network. We can't think about the banking reform in isolation. There are many examples of key players in the banking sector in the United States. I'm going to just, for the sake of discussions today, focus on federal home loan banks. Okay, FHLBs are very key players in the banking network. They're GSCs, and they supply members, banks being members of a FHLB system, with significant advances against collateral. In GFC, their advances reached very nearly $1 trillion, and in 2023, the advances reached about $800 billion. And FHLB has a super lien on the collateral that they take in providing advances, and that has implications for both bank risk-taking and problem bank resolution. So these are some issues that we need to take into account. And recall, 2008, FHLB Seattle was owning a little too much of the private label mortgage-backed securities and was well exposed to Washington Mutual. And we know what happened. Subsequently, they had to be merged. They were put under watch by the regulator FHFA. And so existence of this big player, which is arguably too big to fail and supported by US government, subsidies are estimated by the Office of Management Budget in 2024 report somewhere in the neighborhood of $8 to $9 billion. Okay, they affect the risk-taking behavior of banks. So could we then think about banking reform, not taking into account these big institutions that are out there, affecting the risk-taking propensities of the banks? I will very quickly go through some of the things that we saw when liquidity coverage ratio was implemented in the United States. My colleague Keiron Xiu and I, we looked at the liquidity coverage ratio both within the banking sector and taking into account the presence of FHLB. And what we found was when liquidity coverage ratios were introduced, bank borrowing from FHLB dramatically increased. And what the banks were essentially doing was to essentially pledge their illiquid collateral to FHLB, and they were taking FHLB advances. These FHLB advances received a very privileged treatment in how LCR is calculated in terms of the runoff ratios that were given to FHLB advances. And how did FHLB fund this increased advances that it was making to the banks? What they were essentially doing was basically borrowing from money market mutual funds. But money market mutual funding is very fragile, as we know, because by definition, investors in money market mutual funds have daily liquidity rights. So essentially, we were building in some fragility in the banking network once you take into account these outside players outside of the banking system. So I would like to get some thoughts from the authors about how they view banking reform in light of the presence of these important institutions. A couple of ideas that we can draw from earlier innovations. Reserve Bank of Australia, for example, when they implemented liquidity coverage ratio, they set up what is called a committed loan facility, whereby RBA agreed to provide high quality liquid asset for a fee, which was determined ex ante and which was state dependent. So this is much less balance sheet crowded way of providing high quality liquid asset in the context of liquidity coverage ratio. Could we draw some lessons about how we should think about these kind of ideas where you don't actually impose regulation by crowding the balance sheet with a lot of collateral and liquid assets and thereby affecting aggregate lending in the marketplace? And better coordination between FHLB and discount window. I have seen reports which basically suggest that both SVB and Signature Bank had some difficulty pre-positioning the collateral at the discount window because they couldn't get the collateral back from FHLB on time. And FHLB had the super lien, which puts it ahead of the claims of the FDIC. Now, Amit made a very interesting point in this presentation, how these three banks differ in terms of excessive reliance on uninsured deposit, but these three banks also differed in terms of their excessive reliance on FHLB advances. So if you look at the FHLB advances that were made to Silicon Valley Bank, Signature Bank, and First Republic, they're well outside the peer group reliance on this. So what does that mean? It essentially means that when FHLB starts to provide advances to banks like Silicon Valley Bank, which were being under careful supervision, what is the level of coordination that was happening between FHLB and bank supervisors, for example? How could FHLB be increasing their advances to these players when these banks were not even hedging their risk duration gap, right? So it raises all sorts of questions about how we should think about bank reform when there is this very big player in the market who is able to affect the risk-taking behavior. I would argue these advances, you can see here, the advances were not insignificant, and they have some implications for gambling for resurrection of the sort that Amit talked about earlier in his presentation. Now, the report, for very good reasons, since it covers a lot of ground, does not go into managerial responsibilities. I think the report is focused very much on regulators and early intervention by regulators. I would like to argue that perhaps senior managers should be given some incentives so that they intervene very early before the crisis overtakes the financial viability of the organization. In this context, I would like to take one of the recommendations of the report, which is about a high trigger total loss absorbing capital. If we go down that path and require that banks have to hold high trigger total loss absorbing capital, in the part of the managerial compensation, they should include that in the managerial compensation. And there are a couple of arguments for that. One, by definition, high trigger TLAC is something that's going to get triggered when the bank is a going concern. That is the idea behind the high trigger triggers presence in TLAC. Second, most of the COCO bonds experience is that the triggers are chosen by actually the regulators. It is not on the basis of book value or market value. That means regulators will have high power tool at their disposal to supervise the banks because A, they have the power to trigger this TLAC, and B, they have actually a consequence for managerial compensation if it is part of their managerial package. So I think one of the things that we have learned, at least when I go through the publicly available reports about SVB crisis, is that supervisors actually identified the problem. They simply couldn't enforce it. Compliance from the senior managers. I think combining this TLAC, high trigger TLAC into the managerial compensation and allowing some discretion for the supervisors to exercise this trigger will solve this problem, or at least mitigate the inability or poor ability of the supervisors to enforce these actions. And one last comment that I'd like to make is we have seen ex-ante clawback provisions in other parts of the financial sector. So if it is possible to specify clawback provisions, in good times, of course, senior managers of the bank are entitled to incentive payments. But if they go through 3 or 4 years of very good times, collect a lot of incentive payments, and subsequently, due to managerial failures, the bank gets into trouble on costly resolution, then regulators should have contractually be in a position to claw back some of the previous earnings that the senior managers might have earned in good states of the world. Those are some of the ideas that I would like to propose to the authors. Again, before I close, I want to thank the authors for spending the time and effort in putting together this report. I very much enjoyed reading their report. Thank you.
Oh. So, first, Amit, Stein, responses to Suresh's comments, please.
I'm
and-
gonna let very good comments, and I think we agree with most. We didn't cover all of the issues, so that's in part why we didn't have some of those that you mentioned. I'm letting Amit talk about capital. I think we're going to agree largely that you could raise capital even more in the banking system. And there used to be bankers that said, okay, I'm a fortress banker. I can have more capital and I'm doing actually good banking. And evidence supports it, right? That good banks that have more capital actually don't suffer in terms of return on equity. They lend more, they do better, etc. So the cost of equity is not necessarily that high at the individual bank level, but I think also not necessarily at the system level. Few things, fiscal backstop. You mentioned, Suresh. I agree completely that that's an issue. At the same time, of course, we have a lot of backstop at the moment that are more implicit. And in some sense, what we would prefer to see is we'll make it more explicit. So if you're going to be backstopping a liquidity line for a systemic institution, like in the case of Switzerland, let's design it ex ante, think about it carefully, and on that basis, then act accordingly, rather than on the Sunday afternoon or morning, whatever, come up with this some emergency decree or on the systemic exception of the US case and do these things through the back door. And I think then we have a higher cost. And in some sense, you have quite a few questions on the FHLB as well. I think that's part of the somewhat similar problem that you're in a third or fourth best world in which we have FHLB doing discount window lending implicitly as a second to last resort. We want to review the whole system and maybe, and there's some talk about that in the report that came out from the supervisory agency of the FHLB, revisit the whole structure there. Is it going to happen? I'm not so sure, but that will be a better way of going about doing so. I think I agree completely with what you mentioned there. Last things on incentives and other packages for CEOs and what have you, senior management. Couldn't agree more. Clawback has been on the table for a long time. I don't think we're going to get it easily. I very much like your suggestion that you could do through the compensation, making it part of the TLAC, in some sense get into the quote unquote back door to achieve somewhat of a similar effect as well. But maybe, Amit, let me pass it to you on the capital question and anything else.
Yeah, I think these were great comments. Thank you so much for reading through the report and thinking about these things. I think if I think about the whole lobbying issue, I mean, that's totally reasonable. And that's, I think, primarily also a lever that one needs to, however, push on because of the other things you mentioned. So there is fragmentation and coordination issues. There are many, many regulators. So to expect them to somehow take all of that into account and come up with the exact level of deposit insurance or whatever have you across all the entities which are all being lobbied in different ways is going to be kind of difficult. And that's why I think we need to keep pushing on capital, realizing that there are going to be these other tail winds, which you pointed out. I think when one thinks about private credit, there is a lot of private capital still in the system. And you're right that it might, one has to think a little bit about whether if we push a lot of equity into banking, is it going to crowd out the private market, which is working well? I think one can think about these are all hopefully positive NPV transactions, and we need to let the capital sort that out. But shutting down market signal completely, I think is not a good idea because we do need to know which are potentially solvent banks out there rather than pooling entire banking system, and then we are bailing out effectively the entire system rather than figuring out where the consolidation or restructuring needs to take place. And the last thing I'll say here is your point on limited liability is an excellent one. Actually, limited liability is also one of the reasons why you can imagine why banks are underhedged. So, if you think about multiple equilibria where a deposit franchise is sufficient and no one gets spooked, you end up with one kind of equilibrium, the good equilibrium, or if a lot of people get spooked, like we talked about, you get into another equilibria, but the probability of that equilibria is quite low. And then you ask the managers ex ante, what are they going to do? Are they going to be willing to hedge? Limited liability is going to tell you that they are going to prefer to be underhedged, especially if deposits are going to be backed by a deposit insurance, which is not fairly priced. So I think we are dealing with the same problem affecting many, many things in the system, and it has to be addressed for sure, because ultimately, this all stems from the fact that we have potentially a use for bank deposits. None of us talked much about, but it's implicit in our arguments that the liability side of banking system is useful. Deposits are useful as a liquidity provision for households, for firms. The question is, how important is that? Because all of these distortions are starting from there. Because if you could get that out, then we are back in a world where you sort of emphasize that we can get the skin in the game back to the banker and the shareholder. And I think that's a question that is open, but hopefully some research will get at it, that how much liquidity provision do we need deposits to provide to the system? So thanks again for all the comments, and we agree with you.
Oh. Sorry, it's always on or off. I seem to have it backwards every single time. So, questions. I do not see anything in the Q&A or the chat from online, but if you have a question, please send it in. We've only got about 7 or 8 minutes, so we don't have a lot of time. But I'm also going to look around the room here and ask if anybody has a question that they would like to ask. So, yes, please, here. There's a mic right here. You may have to turn it on. Oh, could you identify yourself? That would be great. Thank you.
Hi, thank you very much for your presentation. Dario Aldati, I'm a postdoc here at Columbia, working also on money finance. I had a first question referring to the presentation by Professor Seru about whether we actually fix the liquidity problem. And I have in mind this later paper by Raghuram Rajan and Viral Acharya about the fact that there is liquidity everywhere, but not a drop to spend it. So I was wondering to what extent we actually have figured that out. And also talking with Nicola Citorelli at the New York Fed, it seems like there are all new sorts of channels that are stemming from channels that we don't understand, even from a New York bank point of view, of monetary policy dripping towards the non-bank financial institutions that have to do with the liquidity. So I was wondering to what extent we actually did fix the liquidity issue. And then I have a question that is a little bit more heroic. If we could decide the ideal level of capital, like we agree we need more capital, what would that be? Like, can we come up to a model that tells us it's 50%, or in an ideal world in which we could just restructure the system from scratch, we should go from narrow banking? Thank you.
Thank you. Thank you for asking the liquidity question. If nobody had a question, I was going to ask almost exactly the same question. Great question.
I'll let Amit.
Stein, you can go first, and then I can follow.
Yeah, I think liquidity, this is not easy because we, in some sense, maybe we had it the wrong way around and have been thinking about it as other people, of course, that we approach this from a microprudential perspective, liquidity. And liquidity in some sense is a macroprudential issue, but by nature, in order for me to have liquidity, I need another counterpart. So it's never that I can solve it on my own. I have to have, and by doing the LCR and the NFSR as a regulatory microprudential tools, you just made a barrier in some sense where the individual bank has to satisfy certain things, but we didn't tell them how it could run it down. We didn't give the right level of that type of liquidity because we asked for HQLA that wasn't always liquid, so they ended up preferring central bank reserves over other things. And in the end, clearly in the individual case that we see, but more in general for the system, I don't think we have solved it. So now going back completely to the regulatory framework and saying we're going to scratch that will take some time. I think we need to really rethink the philosophy. I think part of the answer is the monetary policy thing that I raised. So to the extent we can bring back liquidity to what it used to be, and if you go back 20 years, the Fed had a balance sheet of 50 billion in terms of the interbank market in which it would operate, and Trish can tell me better about it because he was running it. And that is where we should in some sense be in a scarce regime. Now we have 3 billion, I don't know the exact number today. That's true for all banks around the world. So, and that is also related to your second question. Things spread through the system in many ways because we have, and as Amit pointed out, we have, and Suresh, we have all these loopholes for getting to liquidity from the central banks in a very obscure way, where we in some sense, we now have what used to be a payment function of central bank reserves made in a store of value / arbitrage opportunity, because you can earn money on your bank reserves that you could do beforehand. And that's changed the whole paradigm, but we haven't internalized that in terms of the response. That was my answer. In the US context, very, very difficult, because you would want an omnipotent regulator, which is not the right term to use in the first place, but somebody who looks at a system-wide and then thinks about liquidity, where it moves, and how would you respond optimally to it. You raised the question, I don't know the answer. That's why I'm going to pass that meet.
Yeah, I hope I had the answer. So I think both the points are very well taken. They are the holy grail, I think. This is the thing which I was getting at. One thing is for sure, if you look at the US banks and what they are doing on the asset side, you can see that they are now not doing as many loans, but in fact are doing a lot of securities. I think this is the research that Suresh and Kairong also have. And, you know, is it related to different kinds of regulations? Potentially, but maybe it's also related to the kind of reasons why non-banks have risen to begin with, because some of the other regulations, not just liquidity ones, are forcing banks to exit their lending practices to investing in securities. And then what do securities do? Well, they end up funding non-banks. So this is the Rajan and Viral paper that you're talking about. And of course, then that makes the whole thing system connected. So you're right that regulations need to be looked at in totality, and not just liquidity. I would say capital and other regulations as well. And that has repercussions on making the whole system more intertwined than one might desire. So some countries, as you know, look at banks and non-banks together. And maybe that's something that we will have to go to, though it's been a pretty thorny issue, as you can imagine. And with the new administration, I don't know if that's going to be the most receptive direction to go, because they are going to be pushing in the other direction, I would feel. Your second question about optimal capital, like we have done the same set of collaborators, we were interested in exactly that question. The problem is you got to take a stance of simplifying. If you simplified and, you know, pushed and figured out what the optimal level of capital would be, we get numbers like 30, 35%, but that's under a huge number of assumptions. So one has to be a bit cautious on what the number is. You know, 100% narrow banking, you will hear a lot of proposals, but that takes away liability side of banks as having any value, which is the big question. Do corporation and households need deposits for liquidity? And I think we think the answer is yes. How much? That's going to set the bound on where we want with the capital in the final place. So I'll leave it at that.
Thank you. Any other questions in the room? I don't have any online. Thanks, Fernando.
Yes, I have a related question to capital. If you want to comment a little bit more on types of capital. You mentioned TLAC very appropriately and the old CET1. And since we're really talking about true capital, should it be CET1? What are your views at this point on the types of capital and where to push?
Well, I think and I was part of the Basel Committee, and making decisions on these things is a group-wide effort. So you end up sometimes with a lower common denominator than you wish, and that's partly reflected in the capital stack as we have it now, which is a way too much fragmented or differentiated capital stack in part to accommodate these things. There's a lot of tax reasons as well, in some countries at least, that drive these choices. We should, one, I think, simplify. So I'm a big favor of just keeping it very simple CET1 kind of capital. In addition to that, however, we also need to think about how we can release the capital buffers that are needed sometimes to be released, like the COVID shock was a prime example. Then as a committee, at the Basel Committee, we went out and we had to kind of improvise because we ended up reducing macroprudential buffers and microprudential buffers at the same time to allow the banking system as a whole to extend as much credit to the non-banking, the real economy as possible at a time. That was very ad hoc-ish, and in that context was justified, but we would need a little bit of a better way of doing that. So that's a more CCYB approach, the countercyclical buffer, make that a larger component for the extreme events. Don't try to tailor to the cycle, and I think we sometimes overdo it in the Basel context of trying to be too precise. No, we need something very rougher and simpler that at crisis times we can then pull down. Of course, with a proper governance structure behind it, it's not going to be done on an ad hoc basis. It has to be done in a more coherent fashion. I don't know, Amit, maybe you have more thoughts as well.
I think this is a tricky issue. I'm not sure. Like, my view is the more varieties of ice creams we create, the more we are leaving avenues for managers to find and pick and choose the one which minimizes the skin in the game for them, given how everything is set up and with limited liability, like Suresh mentioned. So my view is the simpler, the better. And the pictures that I showed you was the simplest capital. So if we can agree on that number, then other varieties can follow. But as Stein sort of mentioned, it's not going to be easy because of all the push and pull that you hear from the banking side.
Well, we're definitely over time now. So thank you all. Thank all three of the speakers. I really appreciate it. It was a great conversation. Thank you everyone who attended virtually and in person. And I hope everybody enjoys the rest of their day. Thank you again.
Thank you.
Thank you, everyone.